All right. It seems like a lot of the credit concerns have eased a bit, but you do note that credit spreads, they've widened just a bit. They were pretty tight, pretty close to their tightest since the great financial recession. What does that mean that they've only widened a bit? Does that mean that Wall Street's over this?
It does. I think what the market is telling us, and the credit markets and the fixed income markets more specifically, is that they're not as concerned about some of the reports at the end of last week as a few of the equity market shareholders are. And so the positive of that is that historically, the fixed income markets have been one of the best indicators around the true sense of credit markets, how investors are feeling about the balance sheets of a lot of the banks. And so as Zions reported last night, and as we're looking out across the entirety of the financial services group, we think they're in pretty good shape.
What's your view on corporate bonds overall? Last week, we did a story about Fidelity and BlackRock actually shorting corporate bonds in developed nations. How attractive are corporate bonds right now, specifically when we were looking at treasuries, where the yields seem to be declining just about every day?
We still like corporate bonds, and we would skew to higher quality credit, shorter duration. And from Keynes, the idea that the market can stay irrational longer than you can stay solvent. So we really want to be in those higher quality names. We don't want to try to play in the really junky areas of higher credit. We just don't think you're getting paid for that right now because, as you noted at the outset, spreads are still relatively tight on a historical basis. So we don't think you're getting paid right now to take on undue risk.
All right, what's your take on earnings season? We're going to talk much more about this later in the show, but throughout the year, we've often talked about earnings season kind of propping up the market and people saying, well, it's more earnings than AI. The AI announcements are great, but it's really strong and better than expected earnings. What's your view of this earnings season? Do you see any potential landmines or risk out there?
Right now, we think that earnings are still very solid. And if you look across the lens, whether it be financial services, some of the names this week, we've got some consumer names like Coke and Hilton reporting. We've got some of the industrials, GE and 3M. And what we're hearing from corporate executives is that earnings are still very solid. Margins are holding in there. But to your point on landmines, the concern is really around trade policy. Will we see some of these tariffs go through and some of the changes that have been discussed over recent weeks? And will that start to hit margins? Thus far, it hasn't, but that's going to be a big indicator for us. And then the final one would be next month when we start to hear from the retailers. Are consumers pulling back at all? We haven't heard that yet, but that could be a potential landmine as well.
All right. Back to the possible trade issues. The president yesterday saying those 100% additional tariffs on Chinese imports, they could still take effect on November the 1st, but he still plans to meet with Xi Jinping. How concerned are you about the president actually living up to this, I guess, threat against China and the idea of this tariff, additional tariff of 100% being put into place? What do you think that means for the market?
Our hope is that calmer minds prevail and that through those discussions with the Chinese that they can find an amicable solution. It's not going to be perfect. No side is going to feel completely comfortable with what the end result may be. But we want to think of what's best for business. And for companies right now, they need to understand what are the rules going to be. And even if the tariffs might be slightly higher than they had hoped in a specific industry, as long as they know what the guidelines are, they can then pivot, look at strategy, and start to deliver on that. But until they know that, it's really hard to make any concrete decisions.
All right, looking ahead to CPI later this week. So you gave us your estimate, Alan. Your estimate is a 3% year-over-year increase. Obviously, the target's 2%. Does that have implications for the Fed, or do you think the Fed is simply concerned about the labor market right now?
We think they're still concerned about inflation. And while some of Powell's comments last week may have been perceived to be a bit dovish, we think there's still a concern about inflation. But we do think they are going to make another cut coming up. We think that they are concerned enough about the labor market to look past some of this inflationary trend. But as I noted regarding earnings and regarding trade policy, they're still going to have a very watchful eye on what happens with CPI, and particularly in light of the lack of economic data right now. There aren't a lot of data points for them to look at. So CPI is going to be particularly important this Friday.